Hello, I'm Graeme Bibby, Chief Investment Officer at Partners Wealth Group, and I'd like to introduce you today to Brent Severino, Managing Director at Pacific East Coast. Brent, can you tell us a little bit about yourself and Pacific East Coast in relation to the management rights debt fund that we're going to talk about today?
Yeah, sure, Graeme. Thanks very much for having me. A little bit about myself. Brent Severino, Managing Director of Pacific East Coast. Pacific East Coast was founded back in the late 70s in 1978. We're an accounting business that sort of entered into the property market from an investment point of view and really making investment recommendations to other accounting and financial planning businesses around the country. So that's been our mainstay of the business over the last 40 years or so. In the early 2000s, we got an AFSL and responsible entity license. We're licensed to manage investments, and we started to move into that direction as well. We now currently have 5 schemes that we work with around the country. As I said, our expertise is property, so we've always focused on that property side. A lot of our managed investments are hotel accommodation, student accommodation, and then also management rights businesses, which we're discussing today. Our head office is down in Melbourne. I was originally from Melbourne, but not too long ago relocated up to Brisbane due to COVID to run our business up here. So we've got offices in Melbourne, Canberra, Sydney and Brisbane, and are really connected to the property industry over this eastern seaboard of Australia. So yeah, that's the Pacific East Coast story.
That's great, Brent. So the fund is a management rights debt fund. It will invest in second mortgage lending to assist in the purchase of management rights assets. The fund is lending those management rights assets to Tessa Group. Can you tell us a little bit about them?
Yeah, sure. Look, Tessa Group, based in Brisbane, southeast Queensland, property company. Pacific East Coast, through our direct property side of our business, we've worked with Tessa for over a decade on usually brand new and development property side of their business. There's many arms to Tessa. There is Tessa Development, there's Tessa Property and Building Management, and then retail management as well. So no different to your local Ray White shopfront real estate business. What we're talking about here, though, as I said, is their management rights business, and they're one of the biggest and most successful privately owned management rights businesses up here in southeast Queensland. Their retail, residential agency and management rights portfolio probably exceeds over $2 billion worth of properties in it. Its management rights is a really interesting industry. You need a whole lot of skill sets, accounting, legal, and then the nitty-gritty of bricks and mortar, and Tessa's one of those groups that certainly has that full skill set.
So given the business of seeking to finance those management rights businesses, can you explain a little bit about what management rights are?
Yeah, sure. Again, for our clients that are down in Victoria and New South Wales, management rights can seem a little bit tricky or a bit different because it really has been a Queensland-based structure. There are management rights in both Victoria and New South Wales, but management rights are the main agreements that we have up here in Queensland. They were born sort of back in the 1960s out of the Gold Coast market of, the old days of letting the high-rise units on the beach, and used to have Mr. and Mrs. Smith, perhaps from Victoria, that would come up to Queensland and buy management rights where they'd end up with a unit on the building near the beach, and in retirement, he or she may do, one of them might let the units and the other one would clean the pool and tidy up the yard. That's how it all began. It's a much more sophisticated business now. It's a $4 billion industry up here in Queensland. But those sort of key responsibilities haven't really changed. It is the business of operating a residential building, sort of handling the caretaking and facilities management, along with the property management within a complex, that traditional real estate side. And I should say, it doesn't include running the body corporates. Body corporates are a pretty tough business, time-consuming business. Where Tessa sits is they're a client of the body corporate. They have a contract with the body corporate to run the building. I think another thing a bit different about the management rights business, and something our southern clients may not be aware of, that about 60% of the income to a management rights business comes from the contractual agreement to maintain and look after the building. So it's not just reliant on the property lettings as well. So it's a really interesting asset class. Pacific East Coast has been involved in it really since day one, since the 70s. Every Queensland client we've had has ended up in some form of a management rights business when they've invested into direct real estate up here.
So with the evolution of the industry, from those sort of humble beginnings of small developments and small, I guess, owners of them, it's evolved a lot since, and hence the target assets are quite different to way back in those early days. Can you talk a little bit about what the target asset that Tessa was looking to buy and through this fund is looking to finance?
Sure. I think that there's a couple of key points to make here. One of the things that Tessa's, I guess, adjusted to over the last few years, and Tessa have had a lot of management rights assets. They've probably been involved with over 20 individual management rights assets. These are big assets. Some of them are $10 million plus assets. What we're targeting moving forward is the more sophisticated and larger assets. There's a big business of economies of scale in operating these businesses. We're looking for things with that high proportion of the remunerations attached to the caretaking agreements, looking at that security. One important point is we're not talking about holiday lets on the Gold Coast. That's a very lumpy business. There's lots of highs and lows. These are sophisticated buildings. They have a large number of owner-occupiers in them as well. And the tenancies are long-term tenants, which just smooths out our income. If we're looking for larger assets, these might be, apartment buildings with 200, 300 up to 1,000 units in them. If we can't find those in the market, we're looking at putting together asset locations as well and trying to create those economies of scales. One of the things we're looking for as well when looking to buy is the history of the body corporates and the characteristics of the body corporates, so we don't get caught up in any of those issues. As I said, things that we can look at with asset clustering as well. So as you said, it's a really sophisticated model. It's not the old days of the holiday lets. These are some of the biggest and most significant buildings that you'll find in a major CBD or a Gold Coast or Sunshine Coast, something like that.
I guess with that in mind, how have previous management rights assets performed, like for like institutional type or larger assets, and how would you look at them in terms of income and capital gain?
Yeah, sure. Again, Tessa specifically have been, I think it's 21 management rights assets that they've been in and out of. And over the last few years, we've been trading down out of those smaller ones. I guess the history of Tessa with their management rights as well has been that all of those have been funded by CBA. CBA are lending 60% of the asset value on management rights, which is probably a great indication of the strength of that. As part of our fund, the fund will only be lending 20%, and then Tessa are putting in another 20% capital there. So we've got a great mix. That concerted effort to change the portfolio to larger assets has involved selling out of some of the smaller ones over the previous years. And these are the less attractive ones, but all of these have seen significant uplift, big returns on capital, some of those at 100%. And it's a cash flow business. All of them have been an extremely positive cash flow positive asset class. So everything we've learned there, we're looking to maximise into these bigger assets.
And what sort of returns would be targeted by the fund?
Sure. Well, we're looking to pay a 10.25% targeted monthly return. We're paying that monthly because, again, it's an alternative asset, but it's not too complicated. We're running a property management business with a caretaking business on the side. The rents get paid monthly, the agent fees get paid monthly, and our investors' return will get paid monthly to them. So 10.25%, that actually happens from the date of allocation. That will happen. We expect to have probably our first drawdown within 3 or 4 months of that. Investors will also receive, and this is a little bit different on a more high-yielding investment, will get 22.5% of the uplift on that management rights asset. And they'll get 22.5% on 100% of the asset. even though we are lending 20%. That'll be either via sale or through a sworn valuation. So 10.25% paid monthly, 22.5% of the uplift. Total returns, we're probably targeting around that sort of 14 up to maybe 17% return per annum. So quite an attractive package.
Lastly, you did mention the capital call structure. So this will call capital over a period of time. If you could sort of give us a bit of a guidance on that and the total term of the fund.
Sure.
And, that experience of capital drawdown and capital maturity.
Yes, yep. So we're a 7-year term. We're looking to raise a minimum of 5 million up to a $10 million raise. 10% of the investment is required at application, and then the acceptance of the balance as assets are sourced. As I said, we'd expect our first drawdown within 2 or 3 months, and we'll be fully drawn down within 10 to 12 months. We'd only expect to make 2 or 3 drawdowns over that period of time.
That's great. Well, I think that's a really good summary of the opportunity, and also just remind investors that there will be links to more full details, including the offer document and some background videos explaining in more detail about management rights and about Pacific East Coast and Tessa Group. So thank you very much for this briefing today, Brent.
Thanks, Graeme. Thanks for having me.